We get emails from people all over the world who are interested in trading options. And this week I got a thought-provoking email from a guy named Khalid in Germany. I'd like to read that to you and then we can talk about what I thought was interesting. He said, "Hi Seth, I enjoyed your podcast interview a lot. In the podcast you mentioned a bread and butter trade that traders should seek. I thought to myself that selling GLD options, the gold ETF preferably using iron condors, might be a great strategy as I have a good knowledge of gold and its movements. Do you have experience with trading GLD and what are your thoughts on that? Thanks and greetings from Bonn, former capital of Germany," which I did not know. So got a little geography lesson there from Khalid, but also an important question, which is trading gold options, or specifically GLD options, a good idea? Well, you can't answer that question without answering a bunch of other questions. And it's those other questions which I think I want to focus on today, which I'd like to focus on today in this video. When I look at a trading vehicle, and by the way, I think it's a good idea for people to diversify and trade different vehicles. We're seeing that on our trading desk this year as we are diversifying and adding trading vehicles to our market neutral trading. We're seeing a little better balance on a day-to-day basis in the desk's P&L. So I think there's four things you need to look at when deciding whether you can trade options on a particular vehicle, and those are the liquidity of the options, the stability of the trading vehicle's size, and your personal knowledge of that trading vehicle. So let me drill down on each of these a little bit. Liquidity. It might be the most important trait. It certainly is extremely important, and that is it's all great and wonderful to trade options on a particular index that you'd like to trade, or a particular ETF, or a particular stock, or a particular commodity, or particular currency. However, if you can't get out of the position once you've gotten into it, that's what we call the Roach Motel. You can check in, but you can't check out. In fact, here's a picture of the Roach Motel right now. You can check in, but you can't check out. You never want to get trapped in a low liquidity instrument of any sort in any kind of trading, actually, because your profits that you worked so hard to analyze and to develop all go down the drain if you can't execute and exit from the trade. So you may be able to get in, but if there's low liquidity, especially when the thing's moving, especially when you may want to get out for risk management purposes and you can't, that's a very, very bad feeling, and you basically never want to be in that feeling as an options trader. So you don't want to go to the Roach Motel. How do you know if a vehicle's liquid or not? You look at open interest. You determine if it's trading on multiple exchanges. That's a positive. That means there's some competition. And finally, you've just got to go in there and execute. And that's why you have to trade very, very, very small when trading something new, because you don't know what you're going to run into from an execution standpoint until you get in there and trade it. And not just trade it on a calm day, but also trade it on a volatile day. Then you'll get a feel for the execution in that particular instrument. So liquidity is extremely, extremely important when determining a trading vehicle. It's usually the first question I will ask a mentoring student when they talk about trading something new. The second thing is stability. If you are dealing with something that basically day traders and swing traders love to trade because they move so much, it's probably not going to be the best vehicle for you. And I say probably, there could be exceptions, but it's probably not going to be the best vehicle for you for market neutral options trading. It's called market neutral for a reason. You'd rather the vehicle stay within a small standard deviation of its current price. If things are just too difficult and unpredictable and wild, it's going to be difficult to make money in market neutral options trading. Now that's a little nuanced to understand what's called stability and what isn't, and because there's certain vehicles which are not particularly stable, but the options are so richly traded or offered as far as prices that it may actually be tradable. But for someone certainly getting started, you want to have something relatively stable, which is a reason why a lot of people trade indexes, because they're not prone to earnings, which in turn causes massive instability because you can get giant gaps up or giant gaps down. At the same time, if you have something so boring and flat, it never goes up, it never goes down, you're not going to be able to trade that either, because the options are going to have so little value. The prices that will be offered will be so small that you actually are not going to be able to make money. So you need to sort of find that sweet spot where it's volatile enough to create enough options volatility, but not too volatile that you can't trade it. So stability is a second very important trait. A third one is the size of the vehicle. And to me, this is one of those binary events. If it's just under a certain price, you shouldn't consider it after that, because it's too small to trade. Why? How can something be too small to trade? And the answer is most professional options traders will trade vehicles that are very large in size. And because indexes don't have earnings, indexes check off several boxes at once for serious professional options traders. They are both large, and they also do not have gaps, earnings gaps, which is a pretty serious issue for market neutral options traders. It's not fatal, but it's a very serious issue. So indexes are the most commonly traded vehicle on our trading desk. Indexes, I would say, would be 98% of what we do. And I think that's true of most professional market neutral options traders. Why is size so important? That is because of commissions. If you trade something with a 3,000 point size, or let's say in the case of SPX, it's trading today at what, 24.35, all right? That's large. NDX is trading at 57.50, that's really large. The Russell 2000 index is trading at 14.05, that's large. That means you don't need to buy and sell that many options in order to eat up a lot of capital, because those vehicles are so large, the positions require a lot of margin, the profit attainable is also large from a dollar standpoint, and therefore you want to trade the larger vehicles, because brokers will charge you the same commission on an option relating to or derived from a vehicle that's $25 as much as they will for a vehicle that's $25,000. They will charge the same commission, and therefore it's a fixed cost. It is not variable, and therefore if you're using capital, you'd rather have a fixed cost spread over a larger vehicle than a smaller vehicle. So in short, your commission costs are a lot less with a large vehicle, and the commission costs start to become a serious problem if the vehicle is too small. I've seen cases where your commissions in and out are 30% of the potential profit of the trade. Well, that's ridiculous. It's too much. You really want your commissions to be 1% or 2%. You certainly don't want them to be 30%. Then you're just working against too many odds. Your nut is already 30% of the potential profit on the trade, so it's just not worth it. Personally, I find it difficult to trade anything lower than 300, and I prefer really much larger vehicles, 1,000, 1,500, 2,000, etc. So the size of the vehicle is actually purely a commission issue, but it's a very important issue. And finally, and arguably the most important thing of all is exactly what Khalid brought up, which is he knows the vehicle. One of my favorite traders in the market neutral options trading world, Himanshu Raval, once said on a webinar I was attending, he knows the IBM stock like he knows the mole on his wife's back. He's that familiar with the strategy, the the IBM stock. Thus, he has a feel for it. This is a very nuanced point, and it's difficult to explain, but I think most traders understand it. If you know what drives a stock or an index, if you know what it will react to, what kinds of events it reacts to more than others, what kinds of movements occur when certain kinds of news comes out. That's all helpful information for you. If you know a certain report is coming up, I don't know, durable goods or employment situation or something like that, you may know that the particular vehicle you're trading has a strong reaction to those kinds of reports. Well, if you're up 90% of your profit target and one of those reports is coming up the next day, it's probably a decent idea to think about scaling out of it or even exiting the trade as opposed to exposing it to that big event. If you're not familiar with the vehicle, you may not understand how it is going to react. If you're trading oil-related items, the oil inventories report may be a big driver of those particular ETFs or futures contracts or whatever you're trading. But if you're not familiar with oil, you're not going to understand that. So this is nuanced, but very, very important. And therefore, knowing the trading vehicle, which Khalid says he does, is very helpful in his decision-making process. So what's the conclusion? The conclusion is there's no answer to the question, is it good to trade this vehicle? You need to drill down and analyze. Is it liquid? Is it stable? Does it have enough size? And finally, do you know your vehicle? Khalid says he knows GLD, so that makes GLD a decent candidate. I happen to think GLD is a little difficult to trade because it is small. Khalid may want to look at trading GC options, which is the gold futures options, but I know nothing about trading those, and that may be a terrible idea, but it's worth analysis. It's large enough. That's a help. It's in a vehicle that Khalid is familiar with, so that's 2 items checked off. So now he's got to check liquidity and make some determination about the stability of gold. Liquidity is probably his biggest question if he were to take a look at the GC options. And that's not something I can answer, but if you're going to go into such a thing, you ought to do it very, very, very small. You should paper trade it first, you should back test it first, and then dip your toe into the water with the smallest possible lot size you can to trade your strategy to see if you've gotten into the Roach Motel or not, where you have a liquidity problem. So, like everything else in trading, on the surface it seems like a simple question, but actually it's a complex consideration, but a very, very important consideration. Choosing the right vehicle can be the difference between you being a profitable trader and an unprofitable trader. Hope that helps, and I'll see you next week.